Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Today's agenda, we'll go through the market update. I'll update you on the earnings trades, which have started picking up. And then we'll go through Joe's analysis at the end. So let's get started. Okay, major indices, SPX, NDX, everything pretty much state one still. We did have a flip for the energy, went into 8. Everything else is green though. Um, big pie picture obviously had a slight drop, from 83. That was near the high, about 77. So still elevated. We have been making new highs in state one. Yeah, we got, I think, right around 52-ish. So the ones are holding up pretty good. But we're starting to get a little movement with twos, and some of the sevens going back to 8. Overall, still overbought. If we look at 45, we're above that pretty decently. So let's look at the pulse here. So this is ones and eights. So we'll see we got 5, 1, 3, 8. So that's a high so far, and we're getting a little bit. It's better when you pull it out a little. Starting to get a little uptick in the eights. The twos just starting to show up a little bit. We'll see if it continues. Overall, fives and sevens just been pretty much downtrending. Sevens first, fives next, and then obviously there's not that much left to go into ones. If you look at the numbers wise, there's got like 4%. All these other ones still have to move up. Typically some of the fives can jump into one, but pretty elevated numbers overall. Just for the market, being overbought. So we got new highs. Obviously, we had nice spikes there. Still nothing in the lows, pretty much flatlined. That's what we look for in bullish markets. To keep our eye on that. Obviously, since last week, nothing really going on. We had a nice dip, kind of bounced back a little, and kind of. I think the big thing people are waiting for is going to be inflation data. So that comes out tomorrow. I think that'll be a market driver. So let's look at bullish, bearish. So we got up 84. So, down to 77, 78 right now. So things turning slowly, kind of what we expected. Market's still held up pretty good. That was last week. We're pretty much right where we were. So let's get to the charts. They've been very helpful as usual. So the last week, I think we're here, talked about target 3 being showing pretty good resistance here. Had a little pop up and failed. So last 2 days kind of had problems getting higher, but pretty much this numbers, I think, very important right now as far as getting above that and staying above that target 3 level. So we always talk, if we can get above here and hold, and this turns into support, then this can really take off. So right now it's still acting like resistance. Here, obviously right here was big time, got above, just like swooped down, made another run, So really, it's just kind of watching this level for SPX near term. I think that's the key, and that's 47.54. Um, that's it on this chart. We're pretty much getting near the average days. Obviously made a little bit higher move than average, but what's at target 3. Looking at the chart, obviously 50 days kind of have a nice separation. So obviously that's going to be downside support, and that's right at the bottom of our level 4600. So if things do turn over, that 46 can be very important for SPX, staying in that range. I'll do the lines here. So 46 is the bottom, tops up here, 5,000. So, to the upside, we got that, target 3 level, and then, the high here, and then I think the all-time high, Joe, is it 4808 or 4813, somewhere right above that in this range.
Exactly, Josh.
What's that?
That's right.
Mm-hmm. So that's obviously going to be another kind of critical level, but getting above here, then making that run through all-time highs, and then that would be 5K up here. Downside, obviously 4,600. You got your 50 right on it, and that's the bottom of that range there. As far as like the modeling, like the downsides, these aren't as strong, obviously. Entry price is pretty strong, but the 1 and 2s aren't too strong overall. But if they do show support, that's something you can look for. This kind of looked like it showed support, so you don't like just throw them out, but it's just not to the downside as critical as things like this, the entry and then the stops, obviously. But if they act like support, then treat them like that. So this, showing that. So if it does make another run down, I'd kind of, look at that level, and then obviously 46 is the key one here. So upside, you're pretty much right on it, right above it right now. Downside, you got this kind of little level, and then critical level 4,600. So that's it for SPX. Yeah. Okay. And then Russell. So the thing I like right now with the markets is, we got Russell on support, and then the SPX is on resistance. So it's going to go one way or the other. I'm guessing, like for the market, especially since they're both in state one. Overall, it hadn't been a great state one, obviously, but 14 days in out of 36, made a little run. But this is the upper level 2100, the bottom level 19. But obviously near term, you can see this target, this stop loss is acting like support. 2 days, broke down here, but then popped up. Same thing here. So this acts like support, obviously. Provides good support. Then I would expect another run up. I'm getting through here, and then the high for this move, which over here, and then 2100, obviously. But so to the downside, we got support right here, 1962, and then 1900, obviously. Below that, that's the bottom of the range. So quite a drastic move. Since October, that huge move up, and then nice pullback. So what we want to see bullish wise is, because we're in this range, 19 to 21's up here. What you'd like to see is that, hold that 19, if it does test it. So obviously if that holds, then we can get a run up. The previous occasions, I'll pull it out here, where we made runs higher, and this be a broken record on this. It's important. All right. So here's our 19. Oh, not working well. There we go. 19, and then obviously down here 17. So to avoid a four-peat, you already had three where false breakouts out of here, 1, 2, 3. They all came back down and eventually retested 17. So to avoid that, we're going to have to hold 19. This is very critical overall for the market. We're holding 19 here. If not, then it just seems like be another iteration of these mountains that come up and down, and we pretty much end up going nowhere. So that's what I'd be looking at here. Obviously, 19, and near term, holding this target here, the stop loss, staying above that. If that really starts acting like support, then I'd expect it to run. So if not, then we fail, and then we test 19. So that's where we're at. 10 years kind of been quiet. I think tomorrow could be action. We're up above 4. From that move above 5, we had a huge drop down, 3.7 something. So we're back up right around 4. Obviously, keep your eyes peeled on this. Tomorrow will be important as far as inflation. So I'll pull those up first. So tomorrow morning, we have the core inflation, the Fed's favorite. So then regular inflation, CPI. So a lot of big numbers coming out. I'd definitely be watching these closely. Expectations. So, the previous 4 inflation year over year was 4, so they're expecting a little bit below. Then regular inflation rate, pretty much no change. So we'll see what happens here. But as far as Fed wise, nothing in January right now. So that's 3 weeks out. No cut expectation. March, you're starting to see the first possibility. So 1/3 think no cut in March, and then the rest think one or pretty much one. May seems like the this is a quarter cut here, so May is pretty much what the expectation for definitely at least one cut by then. So then as you move out further, December, we didn't have much change here expectation wise. We had 37 last week, 39, pretty much very similar. But the month over month keeps dropping. This is kind of like the median. So the medians here, drop like so. Those keep kind of dropping, and this would be that'd be a lot of cuts, 1.5%. So we'll see if the market expectations are right in the future. But I think just watching inflation, see what the 10-year does, and that's kind of your bread and butter. And we got our key levels for the indices to watch, short term and kind of medium term. Balance sheet, nothing much. I still think March is kind of when we're going to hit like that right around here, 7.5 trillion. And we talked about that before when they had a runoff, a certain percentage of runoff, things started getting dicey in overnight market, and then they turned everything around. So I wouldn't, rule out, pretty much a repeat of that, but so, I kind of monitor the overnight and reverse repo, all that. So just seems like, we'll get around here probably in the March timeframe at some point. But otherwise, just kind of slow and steady on these runoffs. So I think that was it. I didn't have any good charts from Twitter. So I think that's it for the market. Open up to questions, comments.
Can you make that a little bit bigger? The last chart you had, just show it back, make it wider. Look, or can you? Can you?
Like wider like that.
Yeah, I was looking to see where it was before, with the initial. Well, that would, yeah, there you go. That kind of thing. That I was looking for the bump here. Yes. Yeah. So
There
very
we
good.
go.
Very good. The $4 million mark looks like it's would be a target, eventually here somewhere.
Right.
But they've been hearing more talk. This is just my perception, by the way. My perception is because I've been hearing wherever I've been looking, that there's more talk about slowing the runoff of the balance sheet because to act as a counterweight to not overshooting by keeping rates high. They're at 5% where they are.
Yeah.
So people say, well, you can't do both here, or we'll have a recession possibility. So if you're going to leave rates where they are, you should probably not decrease the money supply. That's sort of what I've been feeling, that I've been hearing through my interpretation of the words that get written. And I wonder if that's other people feel that same way, or whether it's just me.
Yeah. I mean, my crystal ball, which didn't.
Yeah, they are what they are. So
yeah. I mean, my thought is, at some point, like with all this new debt, we may see like where the Fed will, reverse course would be, they see rates spiking up because the supply has gotten so big, so they'll have to, and market will have a, big turnover drop, and then, Fed will be like, okay, we're gonna start easing again, and then, they'll bring the rates down by, buying it all, or buying a lot of it. And that's kind of where, because, as long as there's enough demand, the rates won't spike. So, um, but with all this new supply, it's just kind of a wild card, I think, right now. Yeah, but I think Fed's playbook is try and walk, the rates down, keep taking stuff off the balance sheet. But, if there's danger, obviously, any kind of problems, they'll reverse course on the tightening.
Yeah, I think we had not so long ago, we had a record on what the repo window for, thinking about 2 or 3 weeks back, maybe just before, somewhere between Thanksgiving and Christmas, that that was the issue. And the repo window seems to balance out the amount that the Fed is just going to let expire or roll off.
Yeah,
So,
kind of funny.
Yeah. So I see the roll off just continuing until some other news says to stop it, or hold it or whatever. But I've been hearing more of let's not get too over exuberant about removing all of the treasuries from the Fed balance sheet. So anyway, thanks for that.
Yeah. Thanks, Dave.
That's a good picture. I like that picture.
Yeah, this one else, back in 08. We thought this was a lot back then.
Yeah.
Yeah.
Yeah, I'll be happy when we get to 4 million, that 4M mark, if
Yeah.
if we get there. if we get there.
Yeah, this one was crazy. 4 to 9. Anyway. Okay, thanks, Dave. Anyone else? Questions, comments on the market? Okay, had some earnings trades pop. So we had that one non-mover at the beginning. So that one, just kind of do a quick review. That one closed out pretty quick. It hit like the profit target. That was a Menard or whatever it's called, home builder. But that one worked out. And then now we have 4 bullish pre-runners active. So DHI came on it was yesterday, and then these were all previous weeks. So they're up a little bit. They got kind of close to the 25. I don't know, interday. Sudhir's not on, so he would tell me if they hit interday. But so now they pulled back a little from, kind of being right on the cusp. But overall, still got time. 25th, earnings really start kicking off here soon. I think Friday, some of the big banks. So, still get time on these, and we'll see how these do this quarter. Any questions on that? All right, that was it for me. Any questions for Joe takes over? All right. Okay, Joe, you ready?
Okay, Josh. Hi, everybody. Let me grab that screen. Just a couple charts. With the perspective, last week we were talking about, potential Fibonacci retracements off of the October lows to the December highs. Let me touch on that real quick. And then last week I said I'd do some homework on earnings, and I'll speak to that briefly. Found a nugget that I found very interesting, but we'll see. Let's see. Yeah. So as far as the platform here, still wildly bullish. I hope you're noticing the highlighted yellows. This state one, continues to leak higher. Those extremes actually, so the yellow highlights definitely appeared in the late October lows, on the oversold side. And, we've had some here recently, but, just extreme state one by itself, I don't think suggests necessarily, an overbought condition. I think it really is just speaking to underlying strength of the market, like we've talked about before. So a couple charts. Here's Russell. Josh pulled this up, and one of the things we talked about last week, and was this gap. I mean, geez, that's one hell of a gap. And Josh said, the Russell, had a heck of a run coming out of the late October lows. Well, what happened last week? We filled that gap. 1946 was the high. We filled the gap at 1941. As Josh has talked about, that 1900 level, awful important from a support level. It was also the 3/8 retracement of the whole move. We didn't get near it. 1941, we had a big bar yesterday, and let's see what happens. So I just we talked about the idea of this gap filling last week. Lo and behold, it did, and we'll see if it's full speed ahead from here. SPX, and none of the other indexes. XLK, I'll pull that up last, but none of the indexes came anywhere close to 3/8 retracements. I mean, nothing even close. If you wanted to talk about a retracement coming out of the mid-December lows, maybe you get a 3/8 retracement out of that, but nowhere near the big move from October. So I just personally thought, looking at the markets, we come into the new year, got a couple hard days down for sure, but wow, I thought that green bar, on Monday, just suggested, darn, here we go again. And that's still, I thought, in conversation with Josh yesterday, because I've been kind of pretty darn bullish, I guess, on the markets, just in terms of the run that we continue to see and the backdrop being significant earnings for, 2024. I asked Josh yesterday how he felt about things, and I think he puts it better than I do. Cautiously optimistic was Josh's comment. I think that's really the right approach. I'll get into some of the earnings, as I said, but the chart action, they're just, there's not much of a pullback. Here's NDX, just a little blurb, a couple days down, and then, NASDAQ was up 2.2% on Monday, and to me, that's just money flowing back into the markets. That whole wild card, as Josh pointed out, next couple of days, those inflation numbers should be real interesting to see what, see if that is a catalyst for more money flowing into the market, or if, we get a surprise and the numbers, are higher than expected, out of line, and, rates go up and Fed cut expectations change. The next 48 hours will show us some of that. XLK, you almost got to a 3/8 retracement. 180 was a 3/8 retracement. We got to 183, but again, big bar on Monday. So, not that much on the chart side. I just think the price action continues to be, super strong. But on the earnings front, and let me find this here. Couple, I said I'd do a little homework. So what I thought I'd been reading for quite some time was our fourth quarter earnings were going to be up double digits.
Mm-hmm.
It would be the second quarter in a row after 3 quarters year-over-year comparisons down. So, I find this, from FactSet, and this actually Wall Street Horizons, that's a good earnings shop. I think they were bought by the TMX in the last 6 months, but they've been around for a long while. Anyway, it did, give me pause just in terms of the revisions. So, according to FactSet, the market's looking for just a 1.3% year-over-year increase in fourth quarter earnings, down from 8.1%. Even that 8.1 I thought was, lower than what I had been reading, but, a really significant drop in the expected fourth quarter earnings increases. And, then this email speaks to, the size of the drop on average, I guess, and we've talked about this before without really finding sources to quantify it consistently. According to FactSet, it's generally around 3.5% where you see, shouldn't say generally, that's, talking about the 2022-2023 fiscal year, those average revisions were down 3.6%. So anyway, we're just talking about up 1.3%, big time downward revisions going into the release of the numbers. It gives us, I guess, more room for surprises. We shall see. But that's one source, pretty dramatic change, and I just wanted to point that out. Then going a step further to 2024, I think, again, we've talked about double-digit increases in 2024. This fellow's name is John Butters, again, out of FactSet. So overall in 2024, yes, double-digit increases expected year over year, just under 12%. Actually, just under 12% expected. According to these guys, the typical year-over-year growth over the last 10 years has been 8.4%. They get into the weeds here a little bit in terms of the quarters. You can see first quarter 6.6%, second quarter 10.7%, third quarter 9%, and then fourth quarter, and really that's kind of how they were talking about this year as well. Fourth quarter, off the charts at plus 18%. But overall, double digits in the neighborhood of 12%, something for us to kind of keep an eye on once we get through Q4 and, to get into Q1. I'm no economist, certainly, but, my best guess is the price action of the chart suggests that these earnings are going to come in well. One other detail here they talk about is all 11 sectors that, we review and keep track of are expected, of course, to have year-over-year earnings growth. 5 of the sectors are projected to have double-digit growth, and they talk to a few of them: healthcare, communication services, and IT. So, let's see if it starts in earnest Friday. I think if the market's going to have a big 2024, it's going to be driven by earnings. Here are some kind of lines in the sand, if you will, in terms of expectations, and bring it on. So what I wanted to touch on today. Happy to talk to anybody about anything, or pass back to Josh and wrap it up. Anybody?
Say Joe, Dave again.
Hey, Dave.
Joe, I'm remembering back to 2023, this same time of year, and listening to what I heard about conference calls back at that time, and at least where I was listening to, and that's where I'm kind of focused in, so that it's just what my interests are. Most of the conference call, was like, and this is, if you remember, that first quarter of 2023 was after a down 2022. So the sentiment was pretty lousy back at the beginning of last year, like 1 year ago. And a lot of the conference calls I listened to were like, well, we're not too sure what to predict about, maybe we're at the bottom here, so we're not seeing a whole lot of improvement over the first few quarters, but we're very optimistic about Q4, which would be the quarter that we're about to hear earnings from. So now we'll hear what actually, happened after the projections of a really good Q4 last year were. And so my comment is, okay, we're almost at the same point this year, but where did the markets go all last year when we were supposed to have a really huge fourth quarter? I mean, they all went up, right? We're near all-time highs in the SPX and the NDX, right? So
yes.
So did we get the earnings that put the stock move up that way enough yet or not? Well, I mean, we'll see soon. We'll see very soon, but that's where I would be cautious, and I'm optimistic because the economy sounds fairly resilient, but we've had a big run up again for, why? If the earnings don't support that are going to come out in the next few weeks, then, it might be a rocky first couple of quarters for this year. We'll have the same expectations. Now we're at the high end of the ranges instead of the low end of the ranges where we were in Q1 2023. So, and one of the other factors that I sort of try to weigh into my, overall sentiment feeling is the companies that got us to these highs. A lot of the mega cap tech companies, everybody's still sort of focused on tech's going to have another great year, yada, yada, yada. But many of those very same companies are now having to deal with some SEC probes on antitrust kind of issues. So, that seems to be they're saying, well, where are the headwinds? I say that's where one of the headwinds might be that people aren't thinking about too much lately. And they're in those very same companies that ran up a lot. And we still have to see if the earnings are going to support the runs that they've already had in November and December. Anyway, it's going to be an interesting 2 or 3 weeks here. And I think I kind of pick my bullish bearish for the next couple of quarters mindset after the first week of big tech, which is I think the third week into earnings. So not this week, not next week, but the week after. That's where I formulate my go forward and how I'm going to bet and sector wise or industry group wise or whatever for the next coming quarters of options trades and stuff. So anyway.
Thank you, Dave. I mean, and that whole point of, it's not necessarily, it's certainly beyond the Magnificent Seven, but that third week of tech earnings will certainly be one of the more important ones. The cross currents that you read all the time, there's a stat out there. I guess it's the acronym's LERI, LERI, Late Earnings Report Index. And, so that's, companies move the reporting date, out past where they've historically announced because there's bad news coming. That particular index, which again, Wall Street Horizons tracks, that's at a 9-year low. I mean, so here we have these short-term fourth quarter revisions, down from 8.1 to 1.3, but at the same time, there are far fewer companies on a historical basis, getting ready to report later. So, that would seem to be potentially a little bit of a tailwind. So, we'll see.
Mm-hmm. Mm-hmm. Yeah, thanks.
But yeah, next couple of weeks should be a lot of fun. And starting tomorrow with the CPI. Anybody else? Okay. Josh?
All right. Yeah. Okay. Anyone else before we wrap it up? All right. Thank you all. We'll do it again next week.
Thanks for joining. Bye-bye.
Thank you.